Welcome, everyone, to this explainer. Today, we are looking at a truly fascinating company that basically represents one of the most extreme dilemmas in investing right now. Seriously, what if I told you there's a stock out there growing its earnings at a massive clip, trading at absolute bargain basement prices, but carrying a set of risks that would literally terrify a seasoned hedge fund manager? We're tearing down Pampa Energia today, ticker symbol PAM. So, is it the ultimate growth stock, or is it a very, very dangerous trap? Let's dive right in and find out. 25%. That is Pampa Energia's 5-year annual EBITDA growth rate. It's huge. And if you take their financials and plug them into legendary investor Peter Lynch's valuation models, you get a jaw-dropping fair value of $187.68. Now compare that to its current price of around $84. Yeah, you heard that right. According to that math, this stock should be worth more than double what it's trading for right now. So you've got a stock with hypergrowth trading at an extreme discount. I mean, it sounds like the ultimate growth at a reasonable price dream, right? But here is the massive, uncontrollable variable we absolutely have to talk about. The company operates entirely, 100%, in Argentina. And honestly, that one geographical fact completely changes how we have to look at this business. But before we get to the risks, let's quickly run through the baseline metrics just to establish how incredibly cheap Pampa looks on paper. They're Argentina's largest independent energy company. They do oil, gas, electricity, petrochemicals, the whole shebang. And for all that, you're paying a price-to-earnings ratio of just 8.4 and a price-to-book of 1.19, all while analysts are projecting a staggering 30% earnings per share growth. On paper, it's easily one of the cheapest growth stocks on the planet. Okay, moving on to Section 1, the hidden red flags that the mainstream media is completely missing. Because, look, there's a reason this stock is so cheap. The first red flag is the massive elephant in the room: Argentina country risk. Pampa has complete exposure to an economy that is basically plagued by hyperinflation, currency devaluation, and strict capital controls. You know, the Argentine peso has a notorious history. This isn't just a simple business risk we're talking about. This is uncontrollable country risk. A sovereign default or even a sudden political shift could literally cut this stock in half overnight, no matter how well the actual company is run. And beneath the surface, there's a major structural problem developing. Just look at the margins. Gross margin has dropped from a 5-year average of 43% all the way down to 32%. Operating margin? That slid from 40% to just under 35%. So yes, their revenue is growing, which is great, but they are making less and less actual profit on every single dollar of sales. And this brilliantly illustrates the third red flag, the value creation spread. Pampa's return on invested capital sits at 4.74%, while their cost of capital is about 4.0%. That is a razor-thin margin of safety. They are barely creating real value for shareholders here. Just a slight increase in costs or a minor regulatory hurdle pushes this entire equation into negative territory. This is exactly the kind of metric that makes quality-focused investors very, very nervous. Then you have this massive disconnect happening internally. Over just 6 months, there have been 14 insider sales totaling over $41 million. The chairman himself sold 3.3 million shares in mid-2026. Actually, scratch that. It wasn't just him. The CEO was aggressively selling too. Now compare that $41 million to a measly $5.7 million in insider purchases. When the people actually running the company are dumping their shares while simultaneously announcing billion-dollar investments, you really have to ask yourself, what do they know that we don't? Let's rapidly rattle off the final 3 red flags. Fifth, they pay 0 dividends. Every penny goes into capital expenditures, so you're relying entirely on the stock price going up to make money. Sixth is just insane earnings volatility. We are talking EPS swings from 50 cents one quarter up to $4 in another, which makes a standard PE ratio almost meaningless. And finally, their Altman Z-score is 1.84. That puts them squarely in the gray zone, dangerously close to the threshold for actual bankruptcy risk. All right, let's pivot to Section 2, spectacular green flags and the massive upside potential. I know those risks sound incredibly grim, but let's flip the script for a second, because operationally, their execution right now is absolutely off the charts. Just check out these Q1 2026 numbers. Revenue jumped 38% year over year. Net profit jumped 40%. They are hitting record oil and gas production numbers right now, and they are consistently shocking Wall Street. They've had an average earnings surprise of nearly 81% over the past 4 quarters. Moving to green flags 2 and 3, let's see what's actually building their future. First up, their Vaca Muerta shale project. This thing is an absolute monster. It's expected to generate $17 billion in export revenue over its lifetime. It is a multi-decade growth engine. And on top of that, they just approved a $2.7 billion urea fertilizer plant. It's the first of its kind in Argentina in 25 years, and it'll be the largest in Latin America, pushing them straight into a high-margin petrochemical growth vertical. All of those catalysts lead directly to some explosive projections. Analysts are currently modeling almost 14% annual revenue growth and over 30% annual EPS growth. I mean, these are the exact kind of explosive numbers that growth investors absolutely dream of finding. But you might be wondering, how did they survive the chaotic Argentina economy to actually realize that growth? Well, that brings us to green flag 5. They have a fortress of a balance sheet. A current ratio of 3.64 completely obliterates the industry average of 0.89. Their total debt to capital is only 33%. Net leverage is tiny at 1.1x EBITDA. Plus, they are sitting on a $1.67 billion cash position. They are incredibly financially armored to weather economic storms. To wrap up the green flags efficiently, they boast a really healthy Piotrowski F score of 7 out of 9, passing almost every test for financial health. They possess a strong narrow moat because they're vertically integrated. They pump the oil, they generate the electricity, and they transmit it. And finally, the analyst consensus is a strong buy, with an average price target of $120. That represents a massive 40% upside from current levels. So, Section 3, the ultimate face-off. Graham, Lynch, or Buffett? Let's put Pampa through the ultimate value gauntlet, starting with the father of value investing himself, Benjamin Graham. Now, while he would definitely love the low PE and PB ratios, look at the final calculation. The stock's current price of around $84 is sitting right at or just slightly above his calculated Graham number of $83.97. So Graham's verdict? A hold. He'd argue the margin of safety has largely evaporated at this price, and he would hold out for a better entry point. Next up, growth legend Peter Lynch. He sees a PEG ratio of just 0.34, paired with that huge 25% EBITDA growth. Remember that $187 fair value we mentioned at the beginning of the explainer? Lynch's verdict is a resounding strong buy. For him, this is the textbook definition of growth at a reasonable price. He'd be pounding the table to buy this stock. Finally, the oracle of Omaha, Warren Buffett. Buffett looks at the narrow moat, that razor-thin return on invested capital spread we analyzed earlier, the mass exodus of selling insiders, and most importantly, the unpredictable country risk. So Buffett's verdict is a hard pass. The growth and cheap price are super tempting, but without a truly durable moat and facing uncontrollable economic variables, he'd simply walk away. Which brings us to Section 4, the final verdict. Where do we actually stand? So Graham says hold, Lynch says buy, Buffett says pass. Ultimately, Pampa Energia is the ultimate high-risk, high-reward emerging market stock. It's a highly speculative play for aggressive investors who believe in Argentina's energy story and can stomach the crazy volatility. Because of those uncontrollable macro risks we talked about, this is absolutely not a core portfolio holding. It belongs in a small, concentrated position where you only bet what you can truly afford to lose. Which brings us to the most important part of this entire analysis. Your take. I really want to know where you stand on this extreme divide. Do you side with Peter Lynch and buy in for that projected 40% upside? Or are you going with Warren Buffett, deciding that the structural and sovereign risks in Argentina are just way too much to handle? Let us know down in the comments below. And hey, if you found this breakdown helpful and you enjoy these structured deep dives into complex stocks, please hit that like button. Share this explainer with a fellow investor who loves a good high-stakes valuation debate. And make sure to subscribe to the channel so you don't miss our next deep dive. As always, remember, this isn't financial advice. Do your own homework, read those 10Ks, and I'll catch you in the next explainer.